Have you ever wondered what it means to short a stock? In the world of investing, shorting stocks is a strategy that allows investors to potentially profit from a decline in a stock's price. Today, we'll demystify the concept of shorting stocks in a simple and beginner-friendly way. When you short a stock, you're essentially betting that its price will go down. Here's how it works. First, you borrow shares of a stock from your broker. Let's say you believe company X's stock price is overvalued and will decrease soon. Next, you sell the borrowed shares on the stock market at the current market price. This means you're actually selling shares you don't own. After the stock price declines, you buy back the same number of shares you initially borrowed from the market, but at the lower price, which you then pocket the difference. Finally, you return the borrowed shares to your broker, completing the shorting process. Now, let's explore the pros and cons of shorting stocks. One of the advantages of shorting stocks is the potential to make a profit if the stock price decreases, allowing you to buy back the shares at a lower price. Shorting stocks also offers a way to diversify your investment portfolio. When the market is down, shorting stocks can potentially offset losses from your long positions. However, when shorting stocks, there's a significant risk of unlimited losses. This is because when you sell a stock short, there is no upper limit to how much the stock price can rise. If the stock price goes against your prediction and starts increasing instead of decreasing, you are obligated to buy back the shares at the prevailing market price. As the stock price continues to rise, your potential losses also increase. If the stock price goes against your prediction and starts increasing instead of decreasing, you are obligated to buy back the shares at the prevailing market price. As the stock price continues to rise, your potential losses also increase. Unlike buying a stock where the maximum loss is limited to the initial investment, shorting stocks exposes you to the possibility of theoretically infinite losses, as there is technically no limit on how high the stock price can go. This is why it's important to understand that shorting stocks is a more advanced strategy and requires careful consideration. Here are a few key points to keep in mind. Research. Do thorough research and analysis before deciding to short a stock. Consider factors such as market trends, company fundamentals, and any potential catalysts. Timing. Timing is crucial. Shorting stocks requires predicting the right time for the stock price to decline. Keep an eye on market conditions and any relevant news. Risk management. Implement risk management strategies such as setting stop-loss orders to limit potential losses if the stock price goes against your prediction. Another important aspect to be aware of is short squeezes. In some cases, if a heavily shorted stock starts to rise rapidly, it can trigger a short squeeze. This happens when short sellers rush to cover their positions, driving the stock price even higher. During a short squeeze, short sellers may be forced to buy back shares at much higher prices, resulting in significant losses. It's crucial to monitor market conditions and be prepared for such scenarios. One of the most notable examples of a short squeeze and its impact on the financial markets was the GameStop scenario that unfolded in early 2021. A group of individual traders on a Reddit forum called Wall Street Bets collectively bought shares of GameStop, a heavily shorted stock, causing its price to skyrocket. This unexpected surge in the stock price caught many institutional investors and hedge funds off guard, as they had significant short positions on GameStop. As the stock price continued to rise, these short sellers faced substantial losses and were forced to buy back shares at much higher prices to cover their positions, which resulted in collective losses in the billions for these Wall Street firms. The GameStop scenario highlighted the power of retail investors and their ability to challenge established financial institutions. It also sparked a broader discussion about market manipulation, regulation, and the role of social media in influencing stock prices. It's also essential to note that not all brokers allow short selling. Some brokerage firms have specific requirements or restrictions when it comes to shorting stocks. So, if you're interested in exploring this strategy, make sure to check with your broker to see if they offer short selling services. In summary, shorting stocks is a strategy where investors bet on a stock's price to decrease. It involves borrowing shares, selling them, buying them back at a lower price, and finally returning them to the broker. If you found this video helpful, don't forget to hit that like button and subscribe to our channel for more simplified finance content.